Welcome back to the Daily Crypto Deep Dive. Bitcoin was never supposed to end up here. That single sentence frames everything we're about to talk about. Bitcoin was born out of distrust. Distrust in banks, governments, institutions, intermediaries, and the idea that a small group of gatekeepers should decide who gets access to money or opportunity. And yet today, some of the most powerful financial institutions on Earth sit on well over 1 million Bitcoin between them. Not because they're ideological believers, not because they spent years evangelizing decentralization, but because they control the pipes modern money flows through: ETFs, custody, retirement products, regulated investment wrappers. This deep dive is about how that happened, who these institutions really are, how they came to power long before Bitcoin existed, and what it actually means that they are now embedded deep inside Bitcoin's market structure. We're excluding MicroStrategy on purpose. That story is already understood. This is about the institutions that didn't believe, didn't promote, and in many cases openly dismissed Bitcoin until it became impossible to ignore. Together, BlackRock, Fidelity, Grayscale's Bitcoin Mini Trust, and Bitwise now sit on roughly 1.2 million Bitcoin through regulated products. That number alone matters. Ownership in Bitcoin doesn't mean control of the network, but it absolutely means influence over flows, narratives, access, and behavior. And once you understand how these firms came to power in traditional finance, it becomes obvious that Bitcoin's absorption into the system was never going to be accidental. BlackRock is the biggest and most controversial name on the list, and its rise explains a lot about what's happening now. BlackRock wasn't built on bold ideological bets. It was built on risk management. Founded in 1988 by Larry Fink and a small group of partners, the firm became obsessed with understanding how financial systems break under stress. That obsession led to the development of its internal risk platform, which eventually became infrastructure not just for BlackRock, but for the wider financial system. When banks, pension funds, insurers, and governments rely on your systems to manage risk, you quietly become indispensable. But the true turning point came in 2009, when BlackRock acquired Barclays Global Investors and the iShares ETF business. This is where BlackRock became something different. ETFs aren't just investment products, they're distribution machines. They allow exposure to be packaged, regulated, and sold at scale. Once BlackRock owned iShares, it didn't need people to choose BlackRock. People chose an ETF, and BlackRock sat behind it. For years, BlackRock was skeptical of Bitcoin, just like the rest of institutional finance. But demand eventually won. Clients wanted exposure without breaking compliance rules or custody mandates, and BlackRock did what BlackRock always does: it built a product. When it filed for a spot Bitcoin ETF, it wasn't just another application. It was the world's largest asset manager putting its reputation, compliance credibility, and distribution power behind Bitcoin. That single act reframed Bitcoin overnight. It stopped being something advisors debated and became something they could allocate to. Today, BlackRock's Bitcoin ETF holds hundreds of thousands of Bitcoin. Not because BlackRock believes in Bitcoin's ideology, but because it believes in controlling the pipeline capital flows through. Fidelity tells a very different story, but it arrives at a similar destination. Fidelity is private, family-controlled, and deeply embedded in the everyday financial lives of normal people. Its roots go back to the 1940s, and it built its empire through mutual funds, brokerage services, and retirement infrastructure. Fidelity didn't rise by chasing trends. It rose by becoming trusted. That's what makes its crypto story so interesting. Fidelity was early in institutional terms. Long before most traditional firms were willing to touch Bitcoin, Fidelity was experimenting internally, researching blockchain, even mining Bitcoin, and eventually launching Fidelity Digital Assets as a full institutional custody and execution platform. This wasn't marketing, it was plumbing. Fidelity understood that if crypto was going to become a legitimate asset class, institutions would need secure custody and regulated rails. But when Fidelity tried to bring Bitcoin anywhere near retirement accounts, it triggered immediate backlash. Regulators and lawmakers reacted strongly, warning about risk and volatility. And that reaction is revealing, because retirement money is the deepest, stickiest pool of capital there is. Whoever controls retirement allocation controls decades of future flows. Fidelity didn't retreat. It adjusted, kept building, and positioned itself as the safe bridge between traditional finance and digital assets. Today, Fidelity's Bitcoin products hold close to 200,000 Bitcoin. Again, not because Fidelity is ideologically pro-Bitcoin, but because it knows how to build trust-based financial infrastructure, and Bitcoin became something clients demanded access to. Grayscale is the most complicated and controversial story of all, and arguably the most historically important. Grayscale's Bitcoin Trust was formed in 2013, when Bitcoin was still fringe and institutional access was almost non-existent. Grayscale filled a void. It created a wrapper that allowed investors to gain Bitcoin exposure through traditional brokerage accounts. It wasn't perfect, but it was available, and because it was available when nothing else was, it accumulated an enormous amount of Bitcoin. That first-mover advantage became both power and pain. Because the trust structure didn't allow redemptions, shares could trade at massive premiums during bull markets and brutal discounts during downturns. As the market matured and alternatives emerged, Grayscale's high fees and closed-ended structure became increasingly controversial. Lawsuits followed. Pressure mounted. But Grayscale's defining moment came when it challenged the regulator. When its attempt to convert to a spot Bitcoin ETF was denied, Grayscale sued and won. A U.S. court ruled that the regulator's reasoning was inconsistent. That decision didn't just help Grayscale. It undermined the logic used to block spot Bitcoin ETFs altogether and helped crack open the door for the ETF era we now live in. Today, Grayscale still holds a massive amount of Bitcoin, even after outflows into cheaper products, and it adapted by launching a lower-cost Bitcoin mini-trust. A clear acknowledgement that fee competition is now unavoidable. Grayscale's story is messy, controversial, and central to Bitcoin's institutional history. Without it, Bitcoin's path into mainstream finance would likely have taken much longer. Bitwise plays a different role entirely. It isn't a legacy giant. It's a crypto-native specialist. Founded in 2017, Bitwise focused on doing one thing well: treating crypto like a serious asset class. It built credibility through research, index methodology, transparency, and regulatory engagement. When regulators were skeptical, Bitwise was the firm submitting detailed analyses explaining market structure and real trading volume. It positioned itself as the adult in the room. When the spot ETF era arrived, Bitwise launched its own Bitcoin ETF, smaller than BlackRock's, smaller than Fidelity's, but meaningful. Bitwise proves that specialists still matter, but they now operate in a world dominated by distribution giants. The challenge for Bitwise isn't belief or expertise, it's scale. Zooming out, these 5 institutions represent the same underlying shift: the financialization of Bitcoin. Bitcoin didn't lose its decentralized nature at the protocol level. No ETF controls the network. No institution can change the code. But access is a different story. Most new capital entering Bitcoin today comes through regulated wrappers, not self-custody or ideology. And the firms that control those wrappers control the flow. They influence when money enters, when it exits, how narratives are framed, and how risk is perceived. That doesn't mean Bitcoin has been captured. It means Bitcoin has been absorbed. And absorption always changes the character of an asset. Gold didn't stop being gold when ETFs arrived, but the way people interacted with gold changed forever. The same thing is happening to Bitcoin now. The real question isn't whether BlackRock or Fidelity are good or bad for Bitcoin. The real question is whether an asset designed to remove gatekeepers can coexist with institutions that thrive on being gatekeepers. As with most things in this space, the truth lies somewhere in the middle. Bitcoin is still Bitcoin, but the battlefield has shifted, and understanding who controls the pipes is now just as important as understanding the protocol. Thank you so much for listening. Please make sure you are following the show. And as always, we will see you at the top.